As for growth, the MPC noted that elevated energy prices coupled with global supply constraints are having adverse spillovers on economic activity. While domestic demand remains resilient and manufacturing and services sectors activity continue to expand, there are incipient signs of moderation in some sectors as suggested by high-frequency indicators. The MPC was of the opinion that there are considerable risks to the baseline assessment of inflation and growth, which I am going to present shortly, due to the uncertainty about. As for growth, the MPC noted that elevated energy prices coupled with global supply constraints are having adverse spillovers on economic activity. While domestic demand remains resilient and manufacturing and services sectors activity continue to expand, there are incipient signs of moderation in some sectors as suggested by high-frequency indicators. Additionally, the food outlook too remains uncertain on account of subnormal southwest monsoon forecast and El Nino. Although risks of higher inflation have amplified, the MPC felt it would be prudent to wait for greater clarity to emerge. Accordingly, the MPC voted to keep the policy repo rate unchanged. At the same time, the MPC will continue to remain data dependent and closely monitor the developments, including supply side pressures getting embedded in the general price level and inflation expectations. As mentioned, the MPC also decided to retain the neutral stance. I now come to the assessment of growth and inflation. First of all, growth. The second advanced estimates released by NSO placed India's GDP growth for last year at 7.6%. This is owing to strong expansion in private consumption as well as fixed investment. Robust performance of manufacturing and services sectors were the growth drivers from the supply side. As per several high-frequency indicators, domestic economic activity remained largely steady even since the outbreak of the conflict. India's manufacturing and services PMI further suggests that both sectors continue to be resilient and business expectations are still positive. On the demand side, private consumption aided by discretionary spending has remained resilient so far. Fixed investment has also maintained its momentum despite cost pressures. Merchandise exports recorded strong growth in April this year. This is notwithstanding elevated freight and insurance costs. Services exports are also holding up well, reflecting sustained demand despite concerns about AI. Overall, the economic situation has broadly exhibited resilience and withstood the conflict spillovers, although the impact of cost pressures is becoming visible. Going ahead, the rise in prices of energy and other inputs, coupled with supply disruptions, is likely to weigh on economic activity. While import diversification in affected commodities is likely to improve supply, it would still come at a higher cost. The full impact, however, will depend on the duration of the conflict, the time taken for normalization of supply chains, and the burden sharing approach among the various stakeholders. The pass-through of higher energy prices to retail products is also becoming evident. Additionally, the projected deficiency in the southwest monsoon will have implications for agriculture production and rural demand. However, the programs and initiatives for crop diversification, water harvesting and conservation, climate resilient practices and short duration crops, among others, are expected to mitigate the impact. Sustained momentum in services, continuing impact of GST rationalization, and broadly stable employment conditions should continue to support urban consumption, even though rising inflation could be a drag on the purchasing power of households. Government capex is expected to remain robust, while the elevated capacity utilization and sustained credit flows from bank as well as non-bank sources are supportive of corporate investment. Cost escalation and heightened uncertainty could, however, dampen investor sentiment. Weak global demand and high logistic costs are also headwinds for merchandise exports. Services exports, on the other hand, are expected to sustain their momentum as demand for Indian services remain healthy. Several measures undertaken by the government, including support to MSME and export sectors, efforts to ramp up domestic gas and crude production, encouraging use of domestically produced alternatives to imported inputs, and diversification of critical imports should help cope up with the external shock. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.6%. We had earlier projected 6.9%, of course, with huge uncertainty and downside risks, with Q1 now projected at 6.6%, Q2 at 6.3%, Q3 at 6.5%, and Q4 at 6.8%. Prolonged global supply chain disruptions, volatility in global financial markets, and weather-related shocks continue to pose downside risks to the domestic growth outlook. I will now talk about our inflation assessment and outlook. Although firming up marginally from 3.2% in February, headline CPI inflation was below the target during both March and April this year. In fact, 3.4% and 3.5% respectively. While food inflation edged up, fuel inflation remained muted as retail prices of petrol and diesel were unchanged in March and April. Core inflation remained stable at 3.7% during March and April. Excluding precious metals, core inflation was much lower at about 2.1 to 2.2% during this same period. International crude oil prices, the Indian basket, have averaged around $110 per barrel during the last 2 months. And indications are that the average oil prices for this year would be substantially higher than what were assumed during the last policy. You may recall that in the last policy we had assumed crude oil prices to average for this year at $85 per barrel. Higher energy prices and an increase in several input prices also led to a sharp spike in WPI inflation in April. It was more than 8%. Turning to the inflation outlook, the partial pass-through of high global crude oil prices to domestic pump prices of petrol and diesel started in May. Prices of several inputs such as commercial LPG, industrial raw materials, chemicals, base metals, rubber, and plastic products, among others, have increased. These could exert upward pressure on CPI inflation in the coming months as firms pass on these higher input costs. Considering all these factors, CPI inflation for this year now is projected to be at 5.1%, about 50 basis points more than earlier projected. with Q1 at 4.2%, Q2 at 5.1%, Q3 at 5.9%, and Q4 at 5.4%. Core inflation is projected at 4.7% for this year. These forecasts, I may mention, are subject to upside risks due to heightened uncertainty because of a variety of reasons: global supply chain disruptions, global commodity price shocks, uncertainty about the spatial and temporal distribution of the southwest monsoon, and risks from El Nino conditions getting developed.